The Headwater Swordsman here. It's March 21st, 2026. First of all, thanks to the sponsors. Uh, in this video, I'll keep going through. You could call it copium, of course, but in a sense, it's wrong to say it's copium because it's common sensium, I think. It's just sticking to simple strategy of being in undervalued stocks that are will, if they are in fact undervalued, they will go higher one day. So every paper loss in that case is in fact going to end up being a paper loss and not a permanent loss. But I do enjoy the discussing it and also going through examples and looking at history and whatnot. If that works as copium, that's fine, even though again it's not supposed it's the same as when I'm buying something that's cheap. If it's in a downtrend, bear market, correction, I don't see it as being contrarian. I'm just seeing it buying something that's cheap. I don't feel particularly brave. It's just obvious that, hey, if I'm a value investor and something is cheap, it's a buy. I don't feel like, I need to necessarily bet against everyone else. It's just by definition you're obviously betting against the short-term trend at least. But this is supposed to, again, my goal, why I talk so much about investing theory, etc., and majority, I guess, I talk about investing theory rather than individual stock picks, because the idea is that, if the greatest value, if any, I can give someone is obviously to, get people to become good fishermen, not to just throw people a fish, even though I know I hear that all the time, please throw out some names, etc., because people want to know how am I going to make money, or in what am I going to make money. Okay, you're telling me to buy this, I'm going to buy that. Whoa, that's easy. If it was just easy like that, where obviously in reality you're not going to have somebody that tells you what fish to buy all the time, and a lot of people that make a living telling people what fish to buy are actually not good fishermen. They might have a whatever incentive in that story to get people in so they make money on that fish. You know what I mean? With that said, it's not like I'm discussing companies that I have no stake in, so it's I'm not trying to be a total hypocrite, but a lot of people, I think, even prominent people in this business, are not actually good investors, but they get into good deals and then, greater fool trading strategy, and they make money on it. And if you have options, yada yada yada. My goal has if you're gonna make money long term, you have to sooner or later. Or I should put it like this: pump and dump strategy in illiquid juniors, for example, that just works on a small scale, if you know what I mean. Sooner or later, you're gonna have to invest and get into more liquid names, which you can't affect that much. So then it actually matters if you're a good strategy. Most people never actually, how do you call it? Get out of the microcap game. But if you want to be able to scale your portfolio, you have to have big money strategies. And you can't see, you don't see the Lundins, for example, flipping warrants and stuff like that. They buy once and they sell once, basically, and they still kick everyone's asses. So obviously they're like supremely good at investing and making stories work. You could just be in Lundin companies. They have no other option than to make the story work and get acquired or something like that. That's, I guess, a small rant against this industry overall. And a lot of the time, I mean, it struck me, it's like the more time I spend on X, the worse every correction feels. Because you see what 95% of people are focusing on and what they're talking about, what they think is important and all that. And in every downtrend, everyone's obviously talking about that it's going to go lower and all of that. And almost nobody actually looks at just price to value metrics. Yeah, so in my opinion, I feel like if I'm just, in my own head with my own way of looking at investing, I mean, meaning super simple, buy something if it's cheap, hold it until it's not cheap, or I find something cheaper. That's one thing. But then you get exposed to X and you see 1,000 comments every day about anything but that. That's going to weigh on you. Just food for thought. Anyway, gold down yesterday as well. If we zoom out, obviously it doesn't look like a big deal, but I guess as always, the fear. I mean, when people are fearful, they look for excuses to sell and not to buy, obviously. So you're going to be starting to think, this is a 2011 top, etc., which I don't think it is. But anyway, one thing to always note, and I mean this is kind of also basic. First of all, during corrections, deep bear markets, when stuff is really cheap, that's when it matters the most if you actually have a long-term strategy. And a strategy is something that you stick to, right? I mean, as soon as you let feelings dictate your buys and sells, that's not a strategy. I have, I can guess, or I have a feeling what the next short-term move might be, etc., in gold or miners, etc. I just can't let that influence me, because then I don't have a strategy. If my strategy is actually buy stuff that's cheap, I mean, let's call it Warren Buffett strategy, buy good stuff on the cheap. If they're value creators, ride them for until the case is played out, at least. I mean, if you have a 3-year case, the idea is that if you hold it for 3 years, you think you're going to make money. But if you start to buy cases like that and sell them because, hey, I think the next short-term move is down, then that's not a strategy. You had an idea, you had one strategy when you bought, and then you let feelings dictate when you sold. That's not going to end up well. And obviously, at emotional times, and during greed and fear is when it's the hardest to stick to the strategy. Selling if it's overvalued and the short is like a hockey stick, that's not easy. Buying when it's undervalued and it feels like everything is bottomless, that's not easy. But that's when obviously it matters the most. And also, again, just going back to the fact that a company that is cheap, in a sense, is by definition always in a bull market, meaning that every single dip is a paper loss. And especially if they're creating value, the value is going up, obviously, and then you have price trends along the way, and obviously the widest price to value gap is here, and that will also return the best future compounding results. Same thing here, and same thing here. This is obviously, at least in hindsight, a better buy than here because it's a lower price, closer to the uptrend. So compounding goes exponential. Future returns and the amount of time it takes to realize those returns. So, I mean, as always, if something is cheap and it's getting cheaper, selling becomes exponentially worse than holding, and holding becomes exponentially worse than buying. But people sell because they always think that cheap can get cheaper. And in hindsight, it didn't matter if you bought here, there, there. That doesn't matter now. Doesn't matter if you bought here, there. You will make money on every one of these buys below this level over the last 10 years in Lundin Gold, because they were actually executing and were creating value. So even if you overpaid, even at some point in time, the value creation alone is gonna move the price you paid gap to the future values. So there's gonna develop a gap, and you're gonna make money. It's just a matter of time and a matter of degree, obviously. G mining also an executing. So every single one of these dips proved to be paper losses. So that's why I, like Rick Rule, money's made on the micro, in my opinion. But obviously, again, not everybody shares that opinion. And yes, paper prices are falling, but if we look at, this is, I guess, a contrarian signal. We always hear this around times when, or almost always around times when gold is actually quite close to putting in a bottom. Physical trading seems to be going quite well. One thing to always remember: bottoms happen when it feels bottomless. You'll know the bottom was in 6 months after it was in. And I said that in around 2023, 2024 as well. And that's just a fact. Nobody actually knows when the bottom is in. Because you don't know if the rally after a bottom is nobody knows for sure if it's a false, quote, false rally, etc. It's just when the short is much higher that you'll look back and see that was probably the bottom. And that might be, again, 6 months after that you realize the bottom was in, but you can't go back in time and buy that bottom, obviously. So if you're waiting for a bottom to be in, you're probably gonna miss most of the actual returns from the bottom. And I honestly feel like going 2024, I remember, like, some days where I would just look at, there was no trading in some of the juniors. Gold price was maybe, I don't know, $2,600, $3,000, and the juniors were pricing at bear market valuations. Like the sector was horrible, gold was really low, and no project made any sense. And I would just sit there and it's like, how is this possible? In university, when you studied finance, you learned that the market was very rational and all of that. And everybody, I don't know how many financial experts there are out there and wealth managers, and they look at, 1,000 metrics and try to explain everything. And you're sitting there, it's like, this is so obviously mispriced. It's not even, fun. It's not even in the realms of what should be a possibility. The price to value gaps were so enormous, like the biggest ones anyone has ever seen in at least 40 years, coming from 40-year sector veterans. There was absolutely no rocket science needed to figure that. If you looked at a presentation, it's like, okay, what is that project worth? Let's say it's a legitimate project. What's that worth at today's spot metal prices? And then you look at the market caps, like, Christ. You don't even need to. Usually to get a multi-bagger, you're supposed to, well, hold it for a long time. But it's like, typically, it comes with exploration risk. The potential for let's say a exploration play, like, oh, there's a 20% chance this turns into a 10-bagger. Whereas, like, you had de-risked juniors with advanced projects that on paper were worth like multiples and multiples of what the market caps were. That's why, for a long time, and that's still kind of true, where it's like, I used to be in exploration stories, but now it's the, second part of the Lassonde curve, the developers, advanced explorers, the sunk cost, the stories where risk has happened, they've had success, they're just not getting priced like they had it. It's like built in multi-baggers without taking the risk you would think you would need to take to have a price to value gap that's that large. But it was here. It's not like you had to wait for exploration success. It's already happened, and it was still such a price to value gap. Now I just remember, it's like I'd never been more bored in my life because it was so obvious that the next big move was going to be up. And nobody, almost nobody seemed to agree with it because there was no buying in these. And then, of course, we know what eventually happened when everybody's given up and the trend fell bottomless. Fast forward a year, a lot of the stuff was up 300%. And I knew it was going to happen, and I said it at the time because this is ridiculous. It's so obvious that the next move is going to be up. And of course, I was, fully invested. And we're getting to almost those levels again. Sure, gold and silver is down, but it's like on paper, the real projects, they're not mindset. I mean, they're worth multiples and multiples of what their market caps are. It's crazy. It's like I've never seen anything like 2024 before. I mean, 2015 bottom looked nothing like the 2024 bottom. In 2015, no project made any sense on paper. There was no margin of safety. You had to be a contrarian. You were buying low, but you were not really buying anything cheap. You had to have the metals turn around so the projects were actually worth something. Now they're worth a shit ton. It's just the prices are not pricing that in, so you have the price to value gap. You don't even need to be a contrarian. So it's like if you can't buy 2024 or buy at a time like this, for example, forget about buying the 2015 bottom. And also, I mean, I just looked at, we know some silver acquisitions that happened, I guess it was in 2024, around the bottom. And here you have, there was another, I don't remember, there was a third silver junior I think got acquired. It was, which one was that? It was the, what's it called? With, in Mexico, Unicipio or whatever the mine was called, or the project was called. I should have included that maybe. But just look at this, what the valuations were for these acquisitions. So when these silver stocks got acquired, the silver price was $28 and $32. This was the ASIC, I guess, around the time of acquisition. This was the ASIC margin on production at that point. So Gato Silver was acquired for $970 million when they had a $14 ASIC margin. Silvercrest was acquired for $1.7 billion when they had a $17 ASIC margin. The ASIC margins today of the producers and the developers, they're not in production yet, but obviously even at what is silver today, $70 almost. $70. I don't know what the ASIC margin is for a lot of these producers or the developers if their products were in production. But they're much more than this, and this is what some companies paid for that cash flow, that margin. I mean, I think, or let's play around. Let's say you have a silver price of 70. And let's say you have ASIC today of whatever, take 25, not the lowest cost producer. Let's say you're producing 4 million ounces. That's an annual ASIC margin of 180 million US. And then let's take an 8 multiplier on that. That's 1.44 billion US, which is around $2 billion if you would use these acquisition valuation metrics. $2 billion for a not the lowest cost 4 million ounce AG equivalent producer. I don't think they're trading at $2 billion, the one that have 4 million. Or take a developer that might be producing 4 million. I mean, that's one reason why I'm, for example, still, I mean, dip buying like, Sierra Madre, for example. I think they could grow over the coming years to 4 million ounces AG equivalent of gold and silver. I think their market cap is down to 300 million CAD or something, 350. They're not there yet, and there's no guarantees. But yeah, it's pretty obvious that, I mean, are these, for example, I mean, you know me, usually I don't even like silver juniors because it feels like they're chronically overvalued. I think today probably maybe one of few times over the last 10 years that I actually think I like silver juniors. I wasn't really buying too many silver juniors during the recent highs. I think some of them got stretched. But now I think a lot of them actually are cheap. I mean, they are almost by de facto cheap if you look at today's silver price. If you're not guessing too much about stuff that hasn't happened yet in terms of where the silver price is, I actually think they're cheap. Let's look at, this is the Barron's Gold Mining Index. I don't know exactly how it's been calculated. What I want you to focus in on, and this isn't updated, this is a log chart of the same index updated. But that doesn't go back as far. Okay, well. So obviously here we've had put in a higher high, and one, I guess, could get nervous and say, well, if this was a high and these were slightly higher, then we had an epic bear market. But this doesn't really look like what we're seeing now, I would say. I mean, look at the MACD here, for example, compared to here. I mean, this is about the strongest MACD we've ever seen. And I like sometimes use RSI trends, for example, and I would say we've broken out here. And I mean, going back to the monthly chart in gold, which I posted, the RSI line, actually we can look at that. And I don't trade based of these, but RSI is one of few things I actually look at now and then. And we broke higher here, and I posted this around 3,400, and after that it went up like 70%. Usually, I mean, we can look at other, let's say, trend lines. Usually I want at least 3 points, but it's like, hey, it went up here, then mean dipped lower, but that was still when this breakout occurred, there was 9 years of gold bull market ahead, including crashes along the way. Here was the start of the current bull leg. But if this is maybe the mother of all RSI lines, I mean, we broke that in 2025 last year. I don't think I think as a contrarian, this is obviously kind of looks exponential, etc. But I'm prepared for this bull being, well, not close to over, let's put it like that. Also, I would point out one thing here. This is the Barron's Gold Mining Index all the way back to 1939. And if again, this is as far back as it goes, but let's say this is, a long consolidation. I mean, this is like insanely long time periods. I mean, 1939 to 1964. It's like 20 years. But if this was a base, then you see what happened, ripped up. And then, I mean, it just kept going for the next, whatever, 20 years or something. And you see how many, like, I mean, times it went exponential, corrected a lot, put in a bottom, went exponential again, corrected a lot, went even higher. I mean, and this played out for like years. So I mean, since, even if you just count the breakout here, if we can call this a breakout, I mean, it went on a 20-year bull market in the gold miners. And along the way, yes, there was a lot of exponential moves and corrections. And if we look at Huey, for example, I mean, this is what it looks now, obviously. Gone exponential, boom, dropped. How much has that dropped so far? From the top here, Huey, it's down 31%, around 31. So okay, kind of straight down. But I mean, if this is a consolidation, I mean, we might just be, in a sense, back testing this pretty fat base here. Because like a lot of people say, I mean, the bigger the base, the higher in space. And it would be weird if you make a space between between 2011 until 2025, and we have like a year-long uptrend after that. It's like in this, when this base broke, if this is the latest data point, I mean, that's still 20 years of bull market ahead, but it had fat corrections along the way. But if we just look at Huey, for example, from the 2001 bottom, there was plenty of corrections. I mean, here you could say it went exponential, then it retraced 38%, consolidated, went on a ripper again, down 36%, consolidated for years, almost 2 years. But in any case, I mean, the actual bottom after every exponential rip was put in the first, let's say, first 20% of the consolidation period. Even though, yes, it didn't make a new net all-time high, but this was the bottom after this retracement. This was the bottom after this retracement. Looking ahead, you made a shit ton from every single one of these fat retracements. This time it went down 32%. Then we had the big whammer, 71%, and it eventually topped in 2011. But in this case, even for an index, every single bottom should have been bought. Obviously, you would make money the lower it went, the more you bought. Main point might be, I mean, look at how quickly and aggressive the corrections were along the way after every time it just had ripped higher. And I mean, what have we seen recently? Well, we've seen a fat rip higher, and now we're correcting hard, like these times, basically. So who's to say that after this long of a base that we won't have the same kind of ripper, crash, consolidation, ripper, crash, consolidation, ripper, crash, consolidation, like we saw in over this time period? Somewhat crash, I guess. Fat ripper, crash, ripped, crash, ripped, crash, ripped, crash, ripped, crashed, etc. I mean, the most violent rallies obviously happened after the most vertical down movement, in a sense. I mean, this was the 2008 bottom, which is this one here. Almost straight down, and then, you know, not almost straight up, I guess. Straight down, straight up. Straight down, COVID crash, straight up. I mean, here, cascading, made it all back in, I don't know how short of a time frame. This was, I guess, more of a grind, but insane returns a few years out. Super crash, made half of it back in not too distant future. Super returns until the next top. Again, crashing here, made it all back by here. Crash, made half back, crashed again. Fast forward, yes, I know these time frames are kinda, people, as we know, get sick and tired of waiting 3 months today, so forget about waiting 3 years to make multi-baggers, but that's how it goes. And my only strategy since I started in 2000, late 2015, I guess. I didn't know much about the sector, of course, back then. I didn't know what was actually quality, what was actually cheap. I just bought the stuff that looked the cheapest, and at that point I bought the stuff that simply was down the most. And then when I started, understanding more and more about what makes a project and the value of people, etc., nowadays I'm sticking more to quality, but the strategy has stayed the same for 10, 11 years. I just want my portfolio to forever be in cheap stuff where the long-term risks are to the upside. And I don't time anything. I've never sold, I value shuffle, but I've never sold miners. I've been 100% invested and long for more than 10 years straight. So I've ridden every single correction down to the bottom tick. I rode 2015, even though I 2015-16 bottom to the bottom tick. But yes, in that case, I got in late when most of it was down, but my portfolio still went down 46% the first 4 months. So imagine, I was a total rookie, total newbie, didn't know much. My first 4 months in the sector saw my net worth cut in half. And I still stuck to my guns. I thought cheap was getting cheaper. So even though I was a rookie and newbie, I started off by buying what I thought was low and cheap. Then I get kicked in the teeth by almost 50%. And I still stuck to my guns. And 10 years later, that portfolio is up 11,413%, which is a compound rate of about 60% per year. Was higher obviously recently, but it is what it is. Nowadays, so this is in a sense cherry picking. It was last 10 years, and 10 years ago the sector was quite low, but the GDXJ is only up 291% from that low. So obviously I've been outperforming. But nowadays it used to be everything I had used to be in this portfolio. Now it's just one of many portfolios because the bulk of my money is in a private company, for example, and I have stuff at Haywood in placements, etc. But this was done without any placements, any leverage, pretty much only gold and silver juniors. No warrants, no options, only publicly traded junior miners without any market timing at all, as you can see from the amount of corrections. And here, this was Condor, I think. This again is not, I think it might be, this is probably down to 10% of my net worth, this portfolio. So again, it's cherry picking. It's not a diversified portfolio anymore. Concentrated bets a lot of the time. Sometimes you get kicked in the teeth. But I could just keep doing this. It's easier the less money you have, obviously. If you can take advantage of the more illiquid juniors with sizable portion of your portfolio, you'll make more. It's easier to make money. Whereas like my total portfolio, let's say, or my net worth is too big now that I can't really take advantage of very liquid juniors and get a meaningful position anymore. So it's getting harder and harder to compound, let's say. But I'm not putting this up to brag. I'm trying to put this up as, I mean, I'm proud of it, obviously, but I did this without any market timing. And I see so many people on Twitter and people with a lot more followers than me who keep saying how timing is important. Well, this sector sucked for most of the time since I started. Exception being, let's see, where do we have, let's take Huey. I mean, now it hasn't sucked, but during this move, my portfolio, that portfolio showed, I think has underperformed GDXJ. So it's not like my portfolio was kind of went nowhere and then all of a sudden you made 11,000%. No, I mean I think, I mean, even during the bear markets, I don't think that portfolio had a single down year over the time, even though during this multi-year bear market or this multi-year bear market. But again, it also became more and more concentrated. But that was through value shuffle. I mean, at some points, like when stuff I had such high conviction in got so cheap, I just piled in more and more, and then the next wave up came basically. Because as we see, I mean, a lot of there's typically a rally before the year is over. And you can see that here, for example, and this is Huey. I mean, there's a bunch of rallies in between in consolidation and even in downtrends. And if you value shuffle, I mean, I'm happy sometimes. Sometimes I'll be knee deep in a story where it's like I'm so sure this is gonna go up 50 to 100% minimum. It's like it's ungodly cheap, it's low risk and all that, and then a bump comes and I'm like super heavy into that story, and then I value shuffle out of it maybe. But yeah, you don't. I mean, I never needed timing. So from my perspective, it's quite easy why I keep doing what I do, because it's worked for 10, 11 years. I've never sold out of miners because I thought the next short-term move is down. I never even sold highs because I think it's more obvious that the next move down, the next big move is down. If we're at a high, I try to find the ones that are still cheap and shouldn't go down as much. If we're near a low, I'm trying to be in the juniors I think are the cheapest that should go up the most. That's how it is. So I have a harder time finding stuff to buy, obviously, at highs, and my returns into the future are lower at highs. But from the bottom, they get super juiced, because I think I'm in the ones where it's a matter of when, not if, when they're gonna be up a lot. And what else was I gonna say? Oh, I mean, I even calculated, okay, let's assume, okay, I was lucky because I got in late 2015, even though the whole point, I think, I got in because I thought the sector was really cheap in 2015. But I calculated, okay, given this, how much would I need to be down? I think how much do I need to be down for during the lows of 2015 if I invested in 2011 for me to be break even now? The portfolio would need to have gone down 99% something before, and I don't see myself going down 99% from 2011 here. I'm at least that confident in my stock picking that I won't just be in stuff that's on average going to go down 99%, meaning I bought them all super overvalued shit stories and all that. And I think I did a calculations like how much, how big of a paper loss could I afford from here to here? I mean, a full-blown, one of the worst bear markets ever, for me to still be compounding at 20% over a 15-year period. Meaning, let's say I bought started in 2011. How much could I afford to be down by the start of this chart and still compound at 20%, I think, over that period of time? I think I could be down, I don't remember exactly, maybe like 80% or something, or 70. So this is my way of saying the reason I don't market time is that I find no evidence that I need to. I can, or let's put it, this strategy seems to be working that well of no market timing that I don't need, obviously, market timing. If I can survive, if my portfolio can go down 80, 90% or whatever, and you're still gonna be able to make it, what do I need to, I mean, and we're talking long term, obviously, that's the point. This is long term. Short term, I have no friggin' idea where my portfolio is gonna go. Long term, I've seen no evidence of needing market timing, because this strategy seems to do so well over the long term that it's gonna eat away any bear market, any correction in time. The price is, of course, that you have to be long term, where I have years where I'm not performing that well. But over the long term, I mean, I've had, I don't know how many corrections that are 30 to 50% paper loss. I mean, this correction here is, I don't know, 30%. So I'm sometimes I'm losing a shit ton of money. I've had my net worth go down 30 to 50% in months. So at that run rate, you're gonna be broke, whatever, tomorrow. But it still doesn't matter, because if you're in cheap stuff, that can also create value, etc. Every single paper, every single correction, every single dip is a paper loss. I hope that makes sense. And I don't do much technical analysis. I don't even know what the Fed funds rate is. I have no idea where oil and gas prices are gonna go. I don't know where gold and silver prices are gonna be. I just focus on what I know, and that's what the metals are priced at now, what the market caps are now. I do what I can with the information I have. I don't try to predict anything, really. And for 10 years straight, after every fat correction, my portfolio goes up a lot, because mining has not died yet. Simple as that. If you think, or I should put it like this, the day my portfolio might have not paper losses but long-term losses on a whole. I mean, I've had many cases go bad. I've had many cases where I have had permanent losses. I've had cases that went bankrupt. Not, I mean, that was a long, that hasn't happened in quite some time now. But that's the beauty also, that the longer you are in this sector, you get better and better at also picking stocks. But I'm just throwing it out there. This has no market time. That's why I don't give as I keep saying, it's like, I'm not saying it just to stand out. I don't give a shit. I have no idea when this correction is gonna end. This 31% in Huey might not be it. It might, whatever, go down 50%. My portfolio might go down 50% more from here. What I do know is if that happens, there's gonna be stuff that is so cheap out there that I'm probably gonna get 500 to 1,000% returns in the coming years from that low. And that's why I kept saying 2024, for example, that a paper loss of 50% is nothing in the junior space. After this sector bottoms after a correction or a bear market, it goes up hundreds of percent, hundreds and hundreds of percent. If you forget that, you're gonna be selling low and you're gonna see why this sector is so hard to make money in. I already know what's gonna happen after every correction and every bear market. We're gonna have a rally. And I'm more afraid of missing rallies when stuff is cheap than I am of getting more paper losses. But with that said, okay, let's talk a bit at least about, at times like this, at bottoms, when you don't know, the conditions, the financing conditions, whatever, what's going to happen with the metal prices, and we never know that, of course. But I mean, I kind of like stories. Take, still Inflection Resources, for example. It's a very cheap story, not pricing in that much in terms of success. They have around a 30 million market cap. 30 million CAD market cap, and they're looking for tier 1 targets, and they just raise money and are funded by Anglo Gold Ashanti. What if they end up making a tier 1 discovery and they have a 30 million market cap? What kind of a bear do you foresee needing to have for that one to not perform? Are they going to make a tier 1 discovery and be priced at 30 million market cap? Yeah, if the world ends, maybe. Same with, Red Canyon. And I don't, again, I'm not the keenest on exploration stories still today because banked success is that cheap. But the exploration part of the space hasn't even entered a bull market really. We never even got to the part where the end of the risk curve, which is like early stage exploration, really went into a bull market. That's why it feels like the junior sector has a bull market left in the tank at these metal prices because they never really fully revalued yet. So again, if my only strategy is to buy be in stuff that's cheap and be in it until it's not cheap, I have to be in. Regardless if it feels like the world is crashing and the miners might go down a lot more and everybody on Twitter is talking about market timing and waiting for the coast to be clear. And I know, the coast is clear long after the bottom is in. I cannot afford to wait for a bottom to be in to buy cheap. And I think the Red Canyon's market cap's like 15 million CAD or something. And they're also looking for tier 1 discoveries. And also, this is I posted this chart before. This is, I guess, this TSXV. Yeah. This to me looks like a big fat reverse head and shoulders. Again, I'm not saying it's going to be that's going to happen, but who's to say that we don't have a 10 to 20 year bull market ahead of us? I don't know. I know TSXV is cheap. That's all I know. That's all that I need to, and that typically comes with obviously low levels. But Red Canyon has tech involved. That's a 20 billion market cap company. They're not carried though. Unlike Inflection, they're not carried. So they actually have to spend money themselves. But again, I just look at the market cap. Even in the worst of bears, if they end up making a confirmed economic discovery on par with what tech would like to see, for example. Do you think it's going to be at 15 million market cap? No. So I mean, alpha is the only thing that works in, sour sentiment, for example. But I'm not only in alpha. I mean, these are pure alpha stocks. They don't even have beta because they don't have anything really. And now we're going to, again, cheaper levels. So where the value of beta is actually going up. But I can't help myself to have some positions in these as well, because I know that discoveries can work really well even in bear markets. Headwater might be the one of the easier in a sense risk reward, because they're partnered on 6 projects with majors. They're carried on 6 projects with majors. I think the market cap's around 35 million CAD or something. They got Newmont, Cerro Gold, and partnered with Oceana Gold as well. 30% insider. Are they pricing in an economic gold and silver discovery that Oceana Gold, Cerro Gold, or Newmont would care about? Absolutely not. And what's their financing risk? Well, they're carried on 6 projects so far, and they just raise money as well. These or stores like this, they can keep executing and find out if they have a discovery, regardless of what the market conditions are, basically, unless these majors go broke. Other examples of like what been kind of liking, let's say, at times like this, and we can go back to the previous slide for that one. I mean, this is a PA, so assume it's optimistic, and also assume it's with the, let's say, if the oil and gas prices are here to stay. Let's say oil is at 130 million or $130 per barrel or whatever. But even, let's say, double the ASIC to $20 per ounce, and they're gonna come out with a new MRE and a new PA soon anyway. What's their average production now again? It's average silver equivalent. So 8.6 million ounces a year. Let's say 20 million ASIC. $20 ASIC. 8.6. Again, it's like, this is obviously not in operation yet or anything like that. But let's just see what theoretically, if things go really well and this version of the project goes up in production, let's take current price of silver 70 minus, let's say, $20 ASIC, 50 ASIC margin, times 8,500,000 AG equivalent ounces a year. That's a 425 million ASIC margin once up in operation, if things go well. And use the, let's say, average multiplier here for these acquisitions. Let's take this times 8. That's 3.4 billion US, or 4.8 billion CAD. I think their market cap is fully diluted. I think it's around 500 right now million CAD. This is what I'm talking about, where it's like the advanced explorers, developers, etc., they're so cheap that if they just execute, they have kind of built in multi-baggers at the end of the Lassonde curve. Compare that to 2015, when gold price was, or the silver price was, what was it, $15? And let's say the ASIC at that time was like, I don't know, let's say good projects had an ASIC of 10. $5 ASIC margin times, let's take a similar project. 8.5 million ounces age equivalent, that's 42 times 8, 340 times 0.7, 485 versus today 4.8 billion, 10 times more. Do you think the juniors are at 10 times the valuation that they were in the 2015 disaster bottom when almost no project made any money? No. Some of these projects have payback periods of a year today. So, I mean, theoretically, if you get to production, you'll pay your money back in 1 year, and then you're free rolling the rest of the mine life. That was not the case in 2015. So, I mean, I like stories like this because at face value, they're so insensitive to the metal prices. And therefore also, I guess, the oil prices. So who cares what the oil is? Who cares if silver goes down to $50 or $40? Or who knows, even $30, this might be actually kind of okay valued. Cerro De Pasco, another one I'm still averaging down in. Beauty with this is it looks like it has such low capex or opex. And this is a polymetallic deposit as well. But it's like if you get up and running and you see the cost here, excavation and hauling minimal, fuel and equipment cost very low. Basically, don't give a shit what the oil and gas price is. Infrastructure cost almost none. Extraction cost per ton $1 to $2. Do you really care what the... I mean, this is probably, if things go well, this is going to make money regardless of what the metal prices are and regardless what the oil and gas prices are. And you see companies, with projects like this sell off anyway. Because nobody gives a shit about fundamentals. Right now, once some of these, if they end up being in production, people are going to care all of a sudden. So that's the opportunity, obviously. When people don't think that reality matters and they just go lower for emotional reasons, that's great. And if people sell, stories like these where you have to, either tech is retarded or the market is retarded. Or in this case where it's like either Newmont, Centerra, no, okay, I thought it was Headwater. Where's Headwater? Oh, here, Headwater. Either Newmont, Centerra, and Oceana Gold are retarded, or the market pricing is retarded. It's pretty simple stuff. That's the thing. It's like, if the market gets you to forget the obvious, or it's like, yeah, basically that. If the market gets you to not believe what is obvious, then the market wins and you're gonna lose money. But if you can stick to calling a spade, regardless if the volatility is up or down, this sector is a free money printer, future money printer. Right now we're losing money on paper. Another one like Amex, for example, bonanza grade stuff. Champagne zone, 831,000 ounces at 16.2. Where's their PA? Average annual production 102,000 ounces. AISC of 1.165. Gold is at 4,500. And here, phase 2, ASIC drops to 1027. And yes, this is PA. Let's increase it to 1500. That's still a $3,000 ASIC margin today. And this is a low tonnage, high grade kind of operation. So who gives a shit what oil and gas prices are? How high does oil need to be for this? If this study is anywhere close to being correct, how high need the oil price be for this not to make money today? What's the post-tax MPV? $2,500 gold, $1 billion. I think the market cap is 400-500 million CAD today. They hadn't even updated since spot 3,400, which is $1,100 lower gold price. Post-tax MPV 1.8. So on paper, their project is worth more than the current market cap if gold is at $2,000 today. But that doesn't assume higher ASIC and all that, which again I assume a PA is optimistic. Still, let's go with 2,500. Let's say Amex is priced like gold is at 2,500. Then I have a $2,500 margin of safety. I mean, my point is, if you have any sense of being a value investor, etc., this is some of the most no-brainer times we've ever seen. So if you're selling because you think low can go lower, don't pretend like you're an actual long-term value investor at least. Admit it, you're a market timer. And it's because everybody works like that I can value shuffle myself into getting even better long-term results because of these goddamn corrections. Because people don't give a shit about price versus value, and they sell stuff where the value is the same, or whatever narrative that's going on getting people to get scared as hell, they sell, and I'm buying and value shuffling, and then oil price goes up and people get more scared, and then the algos get going, that sells even more. They get other people to sell and stop losses gets hit and all that, and I'm sitting there, it's like open arms, thank you so much. When this correction is over, the portfolio is going to go up 100 to 300%. And it's all because of people like everyone else, like the 95% of people. And I'm just, playing around. It's like, okay, I'm looking at some developers and some developers where I have, let's say, they have, I have an idea when they might be into production. They have an economic study, etc. And let's say, okay, at $4,500 gold, if they're in production in X amount of years at these ASIC margins, what could that be trading at? Well, their market caps could be this much higher, and I'm trying to put in some like 30% dilution for capex, etc. And then okay, in that amount of time, if you could have returned this much, what's the CAGR annual per year? And this is like, my long-term goal is 50%. Well, I can't say long-term. At some point that's going to be impossible to do as well, because it's already getting much harder, but still. Yeah, pretty obvious cases. And I might be, even if I'm off by 50%, these are great upsides and great CAGRs. And then you look at, I put in $3,500 gold, and still this looks absolutely great. The market average is 9% per year. So if these guys, let's say, execute on their projects, and gold is at $3,500 at the time, this assumes like ASIC, no ASIC creep really. So yes, it's a bit rosy still, but hey, I mean, even if I cut these by 50%, that's not a bad, whatever, 5-year return, 3-year return, 3-year, 4-year return. If I can average, whatever, if I could average 25% per year over the next 3-4 years, that's great compounding. And also the twist is that gold might not be at 3,500 in 2 to 3 to 5 years. Gold might be at 6,000 in 3 to 5. It might be at 10,000. So if I, again, it's like, if I'm looking at these valuations and thinking, hey, if these projects, which look legit, execute somewhere along the lines, even close to 30% off of their PAs, for example, if they execute, I'm gonna make money even if gold goes down by the time they're, whatever, in production or close to going into production, for example. So if I think I'm gonna be able to make money if we're in a bear market, what are the returns gonna be from here if gold goes sideways or gold goes up? That's why it feels like if you have a price to value focus in this sector, I feel like I can't lose, because I'm stacking the odds in my favor so much during these corrections, and just keep focusing on price to value, price to value, price to future expected value, risk reward. Yeah, I mean, I'm stacking the odds so much in my favor that, yeah, I'm not really afraid of anything in a sense. I mean, the only thing I see stopping me in a sense is if I start to gamble. Obviously, I might have the best years if I gamble, but I'm also gonna have my worst years if I gamble, and basically the end of the world. But as long as the world doesn't end, this sector is going to be cyclical. As long as I'm in cheap stuff, every dip is a paper loss. I mean, it's so simple. I mean, when you think about it, it's like my strategy is basically as simple as I can possibly make it. I don't have any obvious macro inputs. I don't look at charts too much. I just look what they have, what they might have, and compare it to the price. I've done that for 10 years straight, without any market timing at all, without trying to avoid corrections, and it's worked. And by the looks of it, I can suffer almost any bear market and still have good long-term returns. So all of that tells me continuously, don't try to market time, because it's not needed at all. Honestly, if I tried to start market timing, I think maybe my returns would be considerably worse. If I try to avoid corrections, then obviously I'm not doing a price to value strategy. I mean, or think about it like this, even though a lot of people say, well, don't involve Buffett in this. But what would Buffett do? Let's say he's looking at some companies where it's like they're selling for 20-25% of what they're worth today. Do you think he would sell that because they could go lower? When have you ever heard Buffett say a quote? He even says, good companies at reasonable prices, or fair prices, or something like that. Whereas, like, looking at this sector right now, the good companies are not at fair prices. They're way below fair prices. They're at unreasonably cheap levels. What do you think Buffett would do? Would he not buy that because he think, oh, they can get more unreasonable? That's greed. It's really fear, but technically greed disguised as common sense. If you don't buy something that's obviously way undervalued, how do you justify that? That's the funny thing, where it's like it's the market timers that think they're, let's say, typically poor long-term returns are due to them not market timing well enough, while I'm not market timing at all. Something to think about at least. But at the same time, I mean, what gets the most attention on Twitter and all that? What most topics are? It's what the sector is going to do in the short term. Bar none. Bar none. 90% of the content or something out there is where something is going. I mean, right now, for example, all of Twitter is basically debating when a bottom is in. And I started off this video with discussing where, not when a bottom is in, but yes, talking about bottoms and tops and long-term trends and yada yada yada. But that's in a sense copium for me, because my strategy, if my strategy is value investing, price to value, macro doesn't get into it. And even Buffett said himself, or Munger, they don't believe in forecasting. They don't try to guess anything really macro according to themselves. They just try to find margin of safety and good stories at reasonable or cheap prices. That's it. So yeah, I don't know. And these companies I mentioned, they're not buying recommendations. And since I'm a value shuffler, that's why sometimes it feels weird to, even though, let's put it like this, even though I'm a long-term investor, since I'm always all in, I'm still value shuffling between long-term cases. So if you had whatever, Lundin Gold, which is a long-term case because it's an or has been. I don't own it, but because they have Lundins and a superior management team, so basically the only way to capture that alpha is time held. But if I had a bunch of different Lundin Golds, and I mean similar, and they went like this, so even if both are long-term cases, but one went like that and the other one went like that, let's say I bought it here, then it went up, but this one kept going down, then I could value shuffle this, sell this, even though, hey, I talked about it here, it's a long-term case is intact, but this story here, another long-term story, got cheaper, so I'm value shuffling a bit out of this to capture this, a higher price to value gap. Then it's like, I mean, is that, flip-flopping or pumping, dumping, etc. So my point is that I haven't done much value shuffling last 6 months, except for these last 2 weeks. My point is, I might value shuffle any one of these. Theoretically, that's I guess what I'm saying. So again, don't assume it's like, oh, because I like something now. I'm not going to sell them forever, even if it's a 3-year case. No, I could sell any one of these, let's say if they're 3-year cases, to buy another 3-year case if that got cheaper. I'm probably not going to sell everything, but I might, sell 10% of one and buy 10% more of the other just to use the future returns. So that's why when people ask me also, what are you buying and selling? I typically don't respond to that because I know that can change very quickly depending on what happens with the share price. I'm not trying to predict the market, I'm trying to take advantage of the market. So if Amex shot up 50% tomorrow on no news, and I liked it today, and let's say I bought it today, and it goes up 50%, and all of a sudden some other story I liked equally as much went down 20%, I'll value shuffle out of that. Even if Amex is, let's say it was my number one favorite one day ago, then it shot up 50%. Let's say it's down to my 6th favorite long-term position that day. Well, then I'm a seller, but I still think it's a top 6 risk-reward play. So if people's like, oh, what are you selling? Oh, I'm selling Amex. Oh, he's bearish Amex. I'm not bearish Amex. I'm just more bullish something else at that point in time. And tomorrow, if Amex is down 50%, a day later, maybe Amex is, what I'm mostly bullish on. And that's also why, I don't tell you what to value shuffle. This should come, if you want to, play the market like I do, this should come naturally. The way you look at stuff, you have to have your own conviction and all that. You should learn to fish yourself so you don't need me telling you what to buy or sell, because I don't know what I'm gonna buy or sell on any day, because I don't know what the volatility is. Like I tweeted yesterday, I think I don't really have a game plan on any market day. I'm looking what the market offers me. If there's no real volatility, then there's nothing for me to do. If there is volatility, I might be value shuffling. And it's like I've been catching a falling knife in a kind of a micro cap company, and because I thought it was just getting too cheap, they got money, intact story and all that, and it went from being down, I don't know, 10% maybe on that day, to closing up 12%. My point is, you never, stuff is already absurdly cheap and should have already bottomed. But if you're a market timer, by the time you think that, when people start to feel good about this sector, stuff is going to be up 50 to 100% from the lows. So I cannot afford to wait for the coast to be clear, is my point. You never know when the bottom is suddenly in a particular story, because they're all different. Even though Huey is like that, it's not like every single stock bottomed on the same day. The juniors, they've been kind of lagging. They haven't even traded like this. So it's a company by company perspective, and I'm catching falling knives in stories that I haven't bought. I might have actually been selling a bit of 4 months ago, but all of a sudden they just popped up like, oh, this is becoming a no-brainer. As we know, risk reward goes exponential. Anyway, thanks for listening. Not investing advice. Don't invest money you cannot afford to lose. Again, this is just my take. This is just how I invest. I'm not saying you should, because most people probably shouldn't invest like I do. Don't invest money you cannot afford to lose. Assume I might buy or sell any story I've talked about tomorrow. So take your own responsibility, make up your own mind and all that. Thanks for listening. Bye.